Welcome to the Skeptic's Guide to Investing with Steve Davenport and Clem Miller. Every 2 weeks, Steve and Clem bring you brief investment insights you may not find anywhere else. We hope you enjoy today's episode. Here are Steve and Clem.
Hello and welcome. This is Steve Davenport with Clem Miller, and we're here today to talk to you about Costco. It felt a little ironic as we were talking about AI and all that's going on in the world. And I looked at our Morningstar ratings for NVIDIA, and given NVIDIA's move of the last year and a half, it was a multiple of 50 times forward earnings. And then I looked at a 3-star. And then I looked at Costco, which has been part of our portfolio and part of a lot of people's for a long time. And it's trading at 48.5 times earnings. And something in me snapped. I don't know how a company that's still selling $1.50 hot dogs and slices of pizza can suddenly go from provider of basic services and goods to, competing with the multiples of AI leaders like NVIDIA. Does this mean we should all buy more NVIDIA at 50 times earnings? Does this mean we should sell all our Costco? Because at 48.5 times for a company that makes money from selling you 16 rolls of toilet paper instead of 4, it feels to me like there's a, does helping the American consumer consume more lead you to a better company, a better economy? Or is there something behind this Costco imagery and Costco experience that we need to understand better? So, Clem, what do you think is behind the desire to be into Costco as a stock and a 1 rating, which, if you remember 1 through 5, 1 is overvalued the most, 2 is slightly overvalued, 3 is fair value, 4 is undervalued, and then 5 is most undervalued. Yeah. So is the marketplace making a mistake here with Costco? Or is the marketplace right? And some of these other multiples, some of these other companies with more AI and technology, they're the ones who need to come down.
So I think that, first of all, in the U.S., in U.S. industry, and among U.S. stocks, you have a wide variety of industries and sectors, and there are really good companies in many of these sectors and industries. And Costco is the best in its area of sort of wholesale shopping experiences. They've done really well on a 6-month basis. They've returned 35% versus 15% for the S&P 500. 1 year, 66% versus 24% for the S&P 500. And over 5 years, 242% versus 87% for the S&P 500. And of course, those growth numbers or share price increase numbers are contributing to what you just mentioned, which is the overvaluation. There's no question about that. But then, obviously, as you're asking yourself, Steve, what's leading to this? And I would say a few things. First of all, I think that investors are very attracted to Costco being a dividend growth company. And so that's attracting a lot of investor interest. So over the last 5 years, Costco has generated dividend growth of an average of 12.33% per year, which is really strong. So annualized over 5 years, 12.33%. And they've paid a dividend every year for the last 19 years. So they have had dividends every year for the last 19 years. So that's pretty strong. They have The second thing I would mention that I think is driving this is that Costco has a reputation, or if you look at their prices, they actually produce a narrower number of items at higher price margins than do Sam's Club or BJ's wholesalers. So you can look at that. We all think of, most of us think of the three of them as being similar, but Costco actually has an edge in appealing to, a higher class, so to speak, within that level of consumer. So, slightly more wealthy. I wouldn't say necessarily wealthy, but slightly less poor individuals will go to Costco rather than to Walmart or BJ's.
Well, I joke with my kids about, I want to go to Costco so I can become a millionaire. And I don't know how having those extra 12 rolls of toilet paper are going to make me a millionaire, because I'd have to have a pretty good inventory system to make sure. But it feels to me like Costco is the essence of U.S. consumerism. We believe that it's good to have 4 rolls of toilet paper. It's spectacular to have 16. And I agree that, you should have to have some trade-off. But when I look at consumer prices and I look at individuals, most people aren't getting the price they think they're getting for that Costco brand because of slippage, right? Mm-hmm. Everybody has some slippage. Everybody throws out some soup. Everybody has some stuff that doesn't get utilized as you think it's going to. When it does, because it doesn't, you don't save as much as you think you're saving. And so I guess I find it amazing that a brand can maintain its competitiveness and its margins, even though we know we probably don't need all the stuff we have, right? I was most shocked about the multiples because we're not heading into COVID. We're not heading into a period where everybody is stocking up on wipes and bleach. We're in a period where everybody is stepping away and going outside and doing more things and traveling. And guess what? Costco is getting more involved in travel, getting more involved in other parts of their business. And it's just amazing to me how they can adjust. And I don't want to say it's an artificial world and you got to live in it, but the world around it, it doesn't differ from its focus. It focuses on doing things for consumers that make their experience better, and people will pay for that. And I guess I just wonder, is it a little strange that the company that is so much about value, its stock can be so much overdone in terms of the value it delivers?
Yeah, I would call it a true anomaly, Steve, to look at a company like Costco and see it as valued, as equally valued as, say, an NVIDIA, and actually much more highly valued than some of the other Magnificent Seven stocks. But if you look at
LVMH, the ultimate luxury brand.
Yeah.
If I was to tell you, hey, this is a luxury brand, they're going to come out with a keychain, 200 million Americans are going to buy it. Would that make sense from a perspective of how we consume and how we view things? No. Yeah. And just like this, I find that Costco is kind of getting margin on these items that are higher. have the consumers turned off the "I'm evaluating Costco" button and said, I just love the brand and I'm going to buy it and I'll pay whatever, even if it's a higher margin, because I love the concept. And the concept.
I do think there's a lot of that.
But I thought we were thoughtful economic animals. I thought we made decisions that were more rational and more,
Yeah. Well, it comes back to the, it's almost like the Charlie Munger thing. And I know Charlie Munger at times is like Costco. The Charlie Munger thing about invest in what you know, right? And U.S. investors know Costco, and they know it for better rather than for worse, and so they will invest in Costco.
Do you know if the retail to institutional is higher retail than Costco as an investment? I know you look at how much it's shorted, but do you look at how much institutional ownership sometimes in these names
I
as
don't, as
terms
a
of smart
matter
money
of
or dumb money?
Yeah, I don't, as a matter of regular course in my analysis. But yeah, I mean that's something we can look at, and I could certainly look at it later in the podcast if you talk for a while. uh, but let me. You just mentioned a couple of other things that I think are worth pointing out, which is one is the short interest ratio, which is the short interest as a percentage of float for the company. And actually, it's pretty good for Costco, 1.44%, which means that a lot of short sellers are kind of ignoring it. Now let's compare that to BJ's wholesaler, and BJ's has an incredibly high 9.27% short interest ratio. So that indicates that a lot of short sellers want to, are hanging out, waiting to exercise on their when the stock goes down. I'll point out another thing too, Steve, and I think this goes to impressions that consumers may have about Costco relative to the others. The employees at Costco tend to be very satisfied, or tend to be, satisfied at least. Their Glassdoor employee satisfaction rating is 3.9, and 4.0 is actually the bottom of the range for very satisfied. So they're almost very satisfied, their employees. And if you compare that to Sam's Club, that's at 3.4, and BJ's is at 3.00. So employees are much happier at Costco than they are at Sam's or BJ's.
Do they have a higher percentage off or discount for employees?
Maybe that's it. I don't know.
I mean, I have trouble. It's the two of us now at home. And so if we don't have one of our kids over or we don't have guests coming, it's hard to buy pre-made food because we're just not going to get through it.
Yeah.
And I just kind of look at myself and say, okay, maybe I'm not being frugal enough, or maybe I'm not being, saving us and having it 3 times instead of 2 times. And I just find the Costco conundrum a little bit hard to take. And is it related to AI? Are they becoming, to me, they are always an expert in analyzing inventory and analyzing when to bring something in on a Thursday, and that space should be freed up by Saturday. And here's what we're going to do, a follow up. And that, I mean, they move those blocks and around the floor, and they know what they're doing. They know how things are running and how things are being consumed. And I just think that is it just inventory management, which has been around for 40 years, or is there something new in the way that Costco is managing the business?
Well, I think I think nothing has changed really on the management of the business inherently. But I will say that they are continuing to expand. They're expanding overseas, and that always helps increase sales. And they're also moving more into online, so that helps on their sales as well. So if you look at annualized revenue growth over the last 3 years, it's been 12%, which is pretty high. So double-digit annualized revenue growth, which you compare that to Sam's or to looking at Walmart, which incorporates Sam's as well as Walmart. That's 5% revenue growth over the last 3 years, and BJ's, which is 9%. So 12% is quite a bit higher than those two. And earnings growth, 16% earnings growth for the last 3 years annualized for Costco, versus 8% for BJ's and about the same 17% for Walmart/Sam's Club. So, yeah, I mean, Costco is generally a faster growing company than these other two. And I'd say, if you look at a wide range of companies, 12% annualized revenue growth over 3 years is pretty strong. So that's a very fast growing company. It's profitable, although not that profitable. It's not NVIDIA profitable, but it's.
Yeah, I looked up the institutional holding.
Yeah.
What do you think the number is?
Oh, I don't know.
72%.
Oh, okay. That's good.
I don't know why, Clem, but I think there's going to be some foibles. When I see something mispriced, I'm going to say, boy, the smart institutional people wouldn't be overpaying for this. But here we are, and I'd say that 72 is a pretty high percentage of institutional ownership.
Yeah.
And it's, so what do you think the Intellectia investment group, the intellectual investor, is looking at here that they see they have to have it?
We'll be right back.
We hope you're enjoying our episodes. If you are, then we'd greatly appreciate your liking, following, and sharing. Help us help others. Now let's get back to the discussion.
The institutional investor, right?
Yeah.
As opposed to.
I'm making the presumption that the institutional is also intelligent, which you and I can probably debate back and forth as to.
Right. Well, I would like to think I'm more intelligent than than many institutional investors.
I'm not sure I could get 100% of everybody in this house.
But what do they see? It makes you wonder whether institutional investors are less value conscious than maybe should be, that maybe would be the case if you just look at sort of the academic literature. The academic literature would suggest that value is a very important consideration, and that buying cheap stocks or cheap profitable stocks or cheap stocks at an inflection point of some kind, is the way to go. That's sort of the value philosophy. And it seems here like institutional investors are sticking with those stocks that are growing the fastest. Even if they're at a very high, perhaps astronomical, right? Almost, rate of, a PE ratio or valuation. It's like this, when we look, Steve, when the data that we look at when it comes to valuations are typically forward 1 year, typically for PE ratio. I think a lot of smart institutional investors are saying, that's not the relevant measure of value. It really should be, how is this company going to grow over the next 5 years? And, are they going to grow into that valuation? It may be 50 right now, but is it going to be 25 in 5 years or 20 in 5 years? And so I think they're looking at that and saying that some highly valued companies, are going to grow into that. Not all of them. But
I guess
even Steve, even when
you talk about Snowflake and you talk about companies that are on the cutting edge of biotech.
Yeah.
But when we're talking about a company that, people have been buying and selling milk and ice cream for quite a few years. And so it feels to me like, how are you able to extract more from the same loaf that was sold 2 years ago, 3 years ago, 5 years ago? It feels like if you were going to pick an industry where somebody would be able to take what they're doing and replicate it or do it better or do something as a competitor, like they don't seem to be having more competition. They seem to be taking more competition. So it feels to me something like we keep looking for this intellectual reason why these II stocks are worth more. And yet we have a very simple company right in front of us that we have trouble with determining why is it worth 48 times?
Yeah, that's why, this conundrum about valuation is one of the reasons I look at short interest, because, valuation may not mean a hell of beans, right? If short interest is actually quite low, it's that low short interest indicates that not a lot of short sellers are looking at valuation, at the high valuation, as being a potential problem. I mean, I do see companies out there that have high short interest ratios and have high valuations. And so, those are ones that I'd want to stay away from. And so, it makes me wonder if, at least some institutional investors are also monitoring that short interest ratio.
Yeah. I mean, I don't think I'm going to run away from this stock because it still runs so well and still got a lot of things going for it. But I also think there's a certain mom and popness of, yes, we're going to keep our $1.50 hot dogs. And I don't know how many hot dogs they make, and I don't know how much the true value of the hot dog is, and whether are they losing 50 cents a hot dog?
Yeah.
I think they've got a lot of other things they do well. But
Yeah.
it's interesting to me that they would still focus on that as a reminder to their customers and their consumers that they still care about prices and how it affects you. They still care about inflation. And to me,
Well,
it's kind of like Sam Walton. You can feel like he's put an arm around your shoulder and say, you come shop with me and I'm going to take care of you. And I think it's kind of old school, but in a world of AI, can something as old school as that,
I think it works.
Drive sophisticated institutional investors?
Right. I think that kind of that kind of business model actually works, and I think it actually works well in an environment where you've had higher inflation, and because I think inflation is an issue that is sticky, right, in people's minds. It's psychologically sticky in the sense that, inflation is coming down, right? The rate of inflation is coming down, which is the rate of prices. I don't think a lot of people actually think about prices that way. I think they think about prices as, well, is that price higher than what it was a year ago? And it still is.
I mean,
right?
My wife was so excited about eggs coming down. Oh, look at these eggs. They used to be outrageous, and now they're only semi-outrageous. And I'm like, we don't eat that many eggs. What, I want to figure out where where the big money is. Is it in the meat? Is it in the, and it's just interesting how gasoline, a canister of milk, a loaf of bread, you touch those three prices, and all of a sudden, all hell breaks loose if it goes too much, right? And you look at them as a percent of our overall, economic income, and it's minimal, but psychologically, it has a big impact.
And then you've got this other Costco gimmick of the gold bullion bars. Have you heard about that one?
Yep.
And I think it's a gimmick. I mean, it's obviously a gimmick, but I think psychologically it puts in people's minds that Costco is not a Sam's Club and is not a BJ's. In fact, I think it puts in people's minds that it's not even a Target, right? Even though Target's a step above, you don't see Target selling gold bullion. So it's kind of a curious thing that I think appeals to this certain imagery of Costco being price conscious, because in people's minds, they think about gold, and in many investors' minds, they think about gold as a way to protect against inflation.
Yeah, I mean, I think this goes back to that point, like somebody done a survey at Schwab or someone else said, how many people consider themselves middle class? And 70% of the country does.
Yeah.
Can 70% of us all be middle class? I don't think that's probably realistic, but that, I don't know, that puritanistic, U.S. value orientation where you take those potatoes out of the ground and you clean them off, and you put stuff in the barn for the winter, right? It feels like, for as an advanced economy as we have, there's still some basic, what I'll call Puritan Americana values that most people want to say, oh, I'm not foolish with my money. I'm not doing things that don't make. I shop at Costco. I do that. Here's all my supplies for.
I only buy used.
My 16 water bottles all lined up.
I only buy used cars.
I only buy used cars. I mean, we all want to be in that group, don't we?
Yeah.
That are considered fiscally wise. Some people call me cheap, but I like to say it's more frugal.
Well, you pick what you pick those things where you want to spend your money, right?
Right.
So, I'm not out there buying.
We hide from it, and other times we glory in it, right?
I mean, I never buy a new car. I always buy a few years old car. But on the other hand, I'll take month-long foreign trips. So it's all relative, right?
Right. All right. Is there anything else you want to say about Costco?
No, I think that's it. We've covered a lot of territory there.
All right. Thank you all, listeners to Skeptics Guide. And if you could do us a real favor, give us a like, share the link to the website with your friends. We're trying to bring what we think is honest information to individuals to help them improve their investing IQ. And we appreciate all the listeners, and we appreciate the effort. And we look forward to our next podcast is going to be with a special guest, Dan Solon. Dan has a book out, The Fields Guide for Millennials, and he's trying to help individuals starting off in life to find the way forward to financial well-being. And we want to help them do that as well. So thanks again, and have a good weekend. Bye.
The views shared on this podcast represent the personal investment views of the hosts. They are for educational purposes and not meant to be taken as investment advice. Listeners should consult their own investment, legal, and tax advisors. Past performance of any investments is not a guarantee for future return.